If you're drawing support and resistance like most traders, your chart probably looks clean, logical, and professional. And that's exactly why it keeps misleading you. And this isn't an insult. It's the reason most traders lose money at the best-looking levels. Because support and resistance doesn't fail. The way most traders draw it does. Here's the uncomfortable truth. You're not losing because support and resistance doesn't work. You're losing because you're drawing it the same way everyone else does. And when everyone sees the same level, the market doesn't respect it. It uses it. In this video, I'll show you why most traders draw support and resistance wrong, and how professional traders use those same levels to trap breakout buyers and panic sellers. Stay with me until the chart example near the end, because once you understand why levels break and instantly reverse, you'll never trade first touch support the same way again. Support and resistance is usually the first concept traders learn. You draw a line where price bounced before, and it feels like you finally understand the market. At first, it even works. Price touches your level, reacts, and you feel confident. But then something frustrating starts happening. Price comes to your level, you enter. Price breaks it, stops you out, and then immediately moves in the direction you originally expected. Most traders call this manipulation. Some blame stop hunts. Others blame bad luck. Professional traders don't see manipulation. They see structure and behavior. Support and resistance is doing exactly what it's supposed to do, just not for the people who trade it mechanically. To understand why, we need to talk about how most traders are taught to draw levels. Most traders draw it wrong. The first major mistake traders make is treating support and resistance as exact prices. They draw thin horizontal lines and expect price to respect those lines perfectly. But markets don't move in exact prices. They move in ranges and zones. Support and resistance are not walls. They are areas where decisions happen. When price slightly breaks your line and reverses, that doesn't mean the level failed. It means your understanding was too rigid. The second mistake is believing that more touches make a level stronger. This idea feels logical, but it's backwards. Every time price touches a level, orders get filled. Buyers and sellers get absorbed. Liquidity gets removed. That means each touch actually weakens the level. Professional traders become suspicious of obvious levels. Retail traders become confident. And confidence, in trading, is often what gets punished. Now here's the part most traders never consider. Support and resistance is not about predicting where price will bounce. It's about understanding who is positioned where. Before price reaches a level, ask yourself this question. If this level breaks, who is forced to exit? Because markets don't move to reward patience. They move to punish certainty. The final mistake is entering immediately on the first touch. Price hits support, traders buy. Price hits resistance, traders sell. No confirmation, no context, no information. Professionals don't trade the touch. They wait to see what fails. And this leads to the most uncomfortable truth of all. Sometimes, the best support trade happens after support breaks. That idea alone keeps most traders watching, because it contradicts everything they were taught. Let's walk through a real chart example. Price approaches a clearly defined support zone. It's obvious. Anyone can see it. Retail traders are already planning buys at the level. Stop losses are placed just below support. Price reaches the zone and breaks straight through it. Stops get triggered. Panic selling begins. Breakout traders enter short. At this moment, most traders think support failed. But watch what happens next. Price doesn't continue lower. Instead, it pauses, then aggressively moves back above the support zone. That move wasn't random. It wasn't manipulation. The break below support served one purpose: to collect liquidity. Weak traders exited. Stops were triggered. New sellers entered at the worst possible moment. Professional traders didn't buy at support. They waited for the failure of the breakdown. Once price reclaimed the level with strength, risk became clear, and the trade finally made sense. Support and resistance isn't a signal. It's a location where behavior reveals intent. Support and resistance doesn't need more lines. It needs better questions. Instead of asking, will this level hold? Ask, what happens if it doesn't? That single shift changes how you see the market. In the next video, I'll break down exact entry models using support and resistance, when to enter, where to place stops, and how professionals avoid false breaks without indicators. Most traders never learn this part. If this video helped you see levels differently, Comment levels below. And if you want to stop trading like the crowd, make sure you're subscribed. Because once you see the market this way, you can't unsee it.